All right, so this is for the side channel. Let's do more hot takes on the side channel. So the reason I'm making this video is because I think Hank Green has a really bad take over here, and I want to explain why. When I saw the title of this video, I thought this would be about how he's using AI to manage his money, but not quite. He's actually proposing making a pretty big financial move because of the rise of AI. But let's start with what he's saying about passive investing and broad index funds.
Returns. But if you just made sure that you were invested broadly in the stock market, things went well for you. If you spent all your time like buying and selling and day trading and trying to figure out the best stocks, probably you underperformed the market and you spent a bunch of time focused on something that wasn't adding that much value to the world. But also, if you worked with someone else who was doing that for you, that probably also didn't help very much. Now,
all right, so to his credit, he's 100% right over here. I myself am a lifelong boglehead, and I totally agree with this take. You are much, much better off just investing your money in a very broad passive index fund rather than giving a percentage of your money as fees to an active manager. And there have been tons of studies that validate this. Somehow people still fall for active management. So 100% agree with this take. But let's get to the part that I disagree with.
That Nvidia alone is 7% of the S&P 500. And one of the big reasons I like being in a broad index fund like this is that it is diversified. But now it's just not that diversified. Nearly 40% of the value is in 10 stocks. That's a historic level of concentration.
Okay, again, he's right about this. If you look at most of the gains of the S&P 500 over the last few years, those gains have come from the magnificent 10, as they say, the big 10 tech stocks. And again, he's correct about something like 40% of the value of the S&P 500 today coming from those large tech stocks. So it doesn't feel like a very diversified portfolio with that level of concentration. So again, he's right about that. I agree with him. The mechanics of what he's suggesting, though, are another matter.
I'm taking 25% of the money that I have invested in the S&P 500 and I'm going to put it in a mix of different things. Some of it is going to go into an S&P 500 value index fund, which takes off some of these higher performing stocks that have really high price to earnings ratios. Some of it's going to go into mid-cap stocks, which are just smaller companies.
All right, so I'm going to play that one more time.
I'm taking 25% of the money that I have invested in the S&P 500 and I'm going to put it in a mix of different things.
All right, so that mechanically is just a really, really bad thing to do. So first of all, I'm not a financial advisor, so take everything with a grain of salt, but then neither is he. And just because you're not certified in a field doesn't mean you can't have a rational or evidence-backed opinion about how to proceed. So do your own research. But the mechanics of what he's suggesting, which is selling 25% of his holdings in the S&P 500 to buy something else, are a really, really bad way of doing this. So if all this is in a tax sheltered account like a 401k or a Roth, then it's fine. You can buy and sell as much as you like without any tax implications. But if, on the other hand, this is in a normal brokerage account, then you're going to be on the hook for capital gains taxes when you liquidate 25% of your S&P 500 holdings. Even long-term cap gains taxes are something like 20% on the federal level. And if you happen to live in a state like California, California is going to tax that entire sale as ordinary income. So if you happen to be in one of the higher tax brackets, your entire tax burden from this could be as high as 35 to 40%. So that alone would wipe out any gains you get from this. Again, assuming this is not happening in a tax sheltered account. And he doesn't point that out anywhere. That is a very, very important detail. You can watch his full video, but he doesn't get into the tax implications of this. The other problem is that this contradicts his philosophy at the beginning of the video when he so rightly points out that active investment is a big time sink. It becomes a full-time job. It leads to a lot of stress and worry. And what he's doing with this move is essentially doing some level of active management with his own portfolio. Now, maybe he's buying other index funds like a small cap or mid cap index fund. And that's fine, but you still have to think about how much you're allocating to it, how you're managing the fraction of your portfolio that's in each of these index funds, what's the right fraction, etc., etc. But you're essentially giving up some of the simplicity and worry-free advantages of the Boglehead approach when you do this. The other problem is with his motivation for doing this. Now, he's doing this because he thinks AI is a bubble, and that's fine. There's nothing wrong with having that opinion, but to translate that opinion into such a large financial move, I don't think is a good idea, particularly with the caveat on the tax implications. The other thing to think about is that if AI indeed is such a massive bubble, a bubble of the same magnitude as, say, the housing bubble of the 07-08 global financial crisis, then there probably isn't much safety in small cap and mid cap stocks either. If that bubble bursts, it's going to take everything else down with it anyway. And then he might be better off rebalancing his portfolio into bonds instead, hoping that stocks and bonds don't crash at the same time. That's been the historical assumption of justifying diversifying between stocks and bonds. So a much more financially sound consequence or financially sound way to act out his assumption that AI is a bubble would have been to rebalance into bonds rather than other classes of stocks. Another thing he could have suggested is that instead of actually selling a fourth of his S&P 500 holdings, he could have just paused putting more into that and put his future buy-ins into the market into something else if he felt the S&P 500 was too focused or too concentrated on AI. So there's all these other mechanical ways of diversifying away from AI if that indeed is his core motivation for making this financial move. Because just the way he puts it, I don't think is the best way to even accomplish the goals that he wants to accomplish. So yeah, I thought I'd put this out because he has a pretty big following. Some people might actually take his advice literally, but again, do your own research. This is just my opinion and my experience. All right, so maybe we'll post more on the side channel. Thanks.